Good morning in the States, I suppose. Welcome to Jam Sessions. Today we are going to talk about co-living in Europe, the co-living market or co-living industry, and what the trends are going to be for the next 3 years. So let's begin introducing the speakers, the guest speakers. First of all, you have Esteban Mirai. He's the managing director in Spain for Star City. Then we have Luca Bobone. He's CEO at Habit. Is that right?
Yeah, that's right.
Yeah, okay. We have Tony Cox. He's founder and CEO at Nomos Group. And finally, we have Chris Bledsoe, who is co-founder at Oli. Nice to meet you. So if you want to introduce yourself, give a brief introduction, Esteban, if you want to talk about your professional experience.
Absolutely. First of all, thanks, David and the team at Credit Hall for hosting us. Born and raised in Barcelona, I've spent almost a decade in the States. I was second employee at Star City, saw the company grow over the past 3 years, and starting officially as May 1st, we've launched here in Spain with a base in Barcelona, and we are expanding the business locally. What we've done in California, the same thing in the south of Europe.
Okay, Luca, if you want to introduce yourself, about you.
Sure. Yes, my name is Luca. I'm the founder and CEO of Habit. We are a co-living company here in Europe. We started in Berlin, where now we have over 350 units, and we then expanded to Spain. So we are now in Madrid and Barcelona with over 100 units in Spain, and now soon launching in Portugal and Italy. We're now one of the largest players in Europe. And personally, before starting Habit, I was working in the technology industry, specifically at Dropbox. And thanks a lot to David and Steve for putting this all together. Very excited to get this conversation rolling.
Tony, if you want to introduce yourself.
Sure, absolutely. Thank you, David. Let's see. I'm an investor in a variety of co-living operators. I'm an investor in Open Door Co-living, which is one of the pioneering co-living companies on the West Coast of the United States. I am an investor in Outsite, which is a more hospitality-oriented sort of co-living, global co-living platform, and an investor in Oli, which I'm very grateful to be involved with, the firm that Chris founded. I also sit as a board director on Open Door, and I've recently joined as a senior advisor to Six Peak Capital. But my main role at the moment is as founder and the CEO of Nomos Group Holding, which is really imagined to be a financial advisor specifically focused on the co-living sector. And my background is primarily in investment banking and private equity. And so bringing to bear sort of a capital markets and a real estate heavy investment sensibility to the co-living space.
Okay, that's perfect. What about you, Chris?
Hey everyone, I'm Chris Bledsoe. I'm a founder of a US-based co-living company called Oli, which my brother and I started really dating back to 2011 is when we left our jobs in finance to pursue the business that would go on to become called Oli and a category that would go on to become called co-living. It didn't have a name at that time. So Oli has about 800 units, beds in operation. Recently announced an expansion to the West Coast, about 500 beds. And is an asset-light operating company, so it doesn't own the real estate. It manages, or in some cases, leases through master leases, the real estate. And I will add that I think Tony was being a little bit humble to clearly describe himself as an investor in Oli. He actually played a very critical role in facilitating the introduction to the capital group that would go on to become the Series A lead investor in Oli, which was a pivotal moment for the development of our business.
It's kind of you, Chris.
Okay, that's perfect. Okay, so let's get into matter. Let me ask you something, Esteban. How has COVID impacted in Barcelona co-living rental market?
The last, I think the last 2 months here in Barcelona We've got, just to put sort of a point base, we've got about 120 vets operating today here in Barcelona, scattered across 3 different buildings. And the reality is the last 2 months have been very challenging on the leasing front. I think we've seen sort of 2 trends happen. On one side, we've seen on the supply side, we've seen a lot of flats that were before we were positioned on the vacation rental industry. We've seen the property managers take those flats and sort of reposition them on the midterm space. So if in 2 different verticals, we've seen property managers go and partner with technology platforms like Buddy, for example, and rent them by the bedroom. And on the other side, we've seen them also rent the full service, so the entire units fully furnished with all the services included that they were already offering on the vacation rental side. So we've seen the supply side, we've seen a lot more units come into the market. And then on the demand side, we've also suffered because at least here in Barcelona, and sort of same story in California, co-living works very, very well as sort of an entry gate. So when people first move into the city, it's a great place for them to go and be the first place they stay in the city and stay for 3 months, for 6 months, for 9 months when they just come in. And because of COVID, we've completely seen no new people moving into Barcelona. We've seen no international demand. Obviously, the people that live here, yes, but no new people coming from outside of Barcelona or from outside of Spain. And consequently, we're seeing leases, we're signing leases, we're back to signing leases. The leasing velocity is back to where we were before, but we're seeing a correction on rental prices anywhere between 25 to 30%. And this is something we expect to last 12 to 18 months. We think that the true issue here is on the supply side. The true issue here is that all these flats that previously were positioned on the vacation rental industry, they are now positioned on this midterm space. And we don't foresee returning to the previous rental levels until all these flats are positioned back into the vacation rental back and out of this midterm rental space.
Could there be an opportunity? I mean, could you enter in this kind of in managing this kind of vacational apartments?
Yeah, absolutely. There's an opportunity, and there's been owners who we've had conversations. At least we at Star City and myself as an operator here in Barcelona, we are not a short-term rental operator. We're a midterm rental operator. And I really think that the COVID situation we have, it's something that's going to last for 12 to 18 months. Yeah, there's an opportunity, but capturing the units for only 12 months or for only 18 months, I personally don't see enough value on that. For someone who does see value, yes, there are technology platforms who've been taking this role and they've been renting these larger vacation rental units on a by the bedroom basis.
Okay. What about you, Luca? I suppose that Berlin is a much major market. So how has COVID-19 impacted in Berlin co-living rental market?
Yes, so thanks for the question, and I think it was really interesting to hear Esteves speak, about Barcelona. Obviously, we do have some units in Barcelona, actually one building with 23 units, so not as large as Star City's portfolio, but we also have 100 beds in Madrid. So we have seen basically some similar trends to Barcelona market that Esteves was talking about, also in Madrid, with actually quite strong contraction in demand, while I can tell you that in Berlin, where the majority of our portfolio is, this really didn't happen. So obviously we had the period in March where new applications, new entrants were like sharply declined, and that really caused a gap of occupancy, but we are already back at selling as many rooms as we were pre-crisis. So the way the German government has handled this situation has been highly professional. So there hasn't been any full lockdown at all in Berlin. So people were able to move, they were able to go to work to some extent. There was really just maybe a couple of weeks period where there was like no restaurants opening and so on. And that really like made sure that the situation was not sort of panic mode and people were still be able to move and, you know, change apartment and so on. As well as we didn't see such, I mean, because of all the help from the German government from an employment perspective, people are still receive their salaries, still receive their benefits and so on, which makes it a much easier case, you know, to sell if you still have your salary, or everybody still gets paid, basically, you know, which is much different compared to Spain and to Italy, for example, where the situation is not as easy. As a result, just to give you, please.
Sorry, Luca, do you think this is a key fact? All the governments, all the subsidies that government gives in the German market?
Sorry, I didn't catch the first part of your question.
Do you think that this is a key fact in terms of people acceding to co-living beds in Germany market instead that in Spain? Because here we don't have this kind of subsidies.
Well, yeah, so it's I mean, it's just a really very fundamentally 2 points, right? So number one, people in Madrid could not move for like 2 months, right? And they just got out of the lockdown. That's a very fundamental thing, that you just couldn't change your apartment. And the second thing, people did not receive any money at the end of the month, probably for the last 2 months. And so this did not happen in Germany. So people could move, and people did receive at least, you know, 70, 75%, 80% in some cases of their net salary, all of them. So you basically, there's no people in Germany that didn't get paid for the past 3 months, which obviously creates a much healthier environment. And while the panic really basically stopped after maybe the first week of April, then applications went back up. There was a price adjustment that I would say is probably 5 to 10%, but not more. And now occupancy is back into the high 80s, which is a very strong number. While the occupancy in Spain is really stayed much lower. So in probably the high 60s, you know, that's where we are, what we're looking at right now. So I mean, the difference in the way that it has been handled now, you know, on a medical perspective, health perspective, I don't know, you know, if there was a significant difference, but certainly, you know, the way it has been handled has created this major gap, and we're actually quite fortunate that the majority of our portfolio is in Germany and not in Spain, because we would be in much bigger trouble otherwise.
Chris, let me ask you something. Can you give us a quick overview of the US market in this sense? Have you been able to notice these trends?
Yeah, and you know, I'll speak you know, as a representative of the industry rather than as anything specific to Ollie here, as I'm no longer managing day-to-day operations at all.
About the industry, yeah.
Yeah, but everything that I've seen so far is that it's a very case-by-case basis. So for assets that might have anchor demand that's anchored by a university, and maybe that asset has fuller graduate student demand, for instance, there's actually been an interesting dynamic. As the universities shut down their housing, it displaced a lot of students who didn't have the option or elected not to go back to their, you know, home markets, and so they needed you know, some other alternative housing solution. And in those cases, co-living assets have served to actually absorb some of this dislocated demand from, you know, from university students. So if you're co-located near a university, counterintuitively actually has been helpful in many cases for co-living. Generally, though, what we've seen in the US is very significant seasonal absorption. And we're probably about a week and a half away from what I would consider the start of the peak seasonal demand period for co-living in the States, kind of June 15th through, I'd call it about early to mid-September. And then you really see just seasonally demand, you know, really fall off a cliff. So I think the outlook for co-living will really depend on what happens over starting in the next week or two, all the way through kind of September. At this point, but I think it is still early to draw any conclusions. But at this point, I think co-living, the worst has been spared so far in the States. And I one caveat to that is there is sometimes definitional confusion about what co-living means. To Ollie and to me, co-living is not to be confused with the shorter duration stay product. I consider that to be co-lodging, if you will, and that would be like the Saunders or Stay Alfreds, Lyric, some of the other players who play in that shorter term space. That acts more like a hotel market, more like hospitality industry, and of course, that's been severely impacted. And so to the extent that co-living operators do have exposure to shorter duration stay product in their portfolio, you could expect that demand evaporated pretty quickly, just like the hotel
demand. Let's introduce, Stoney, the investment factor. What do you think that needs to happen in order to see big techies entering on the market?
Yeah, happy to answer that one. And it's interesting, Chris, I might just respond quickly to your observations, about sort of hospitality and the longer term stay. I agree with the definitional sort of dichotomy around longer stay being co-living and sort of the shorter being co-lodging. Outside, which is a company that I'm, have been involved in a little bit, is an interesting kind of a tweener in that space because they are longer duration but short stay. So they're, tenants or residents are typically staying for sort of three weeks, 6 weeks, that kind of thing. And because co-working is having sort of such a moment, and because the truly global nomadic populace, that's in that target market, and which may be sort of relevant also, Esteve, to the comments you were making, because they really are not living in a specific place that they're going home to from a hotel, for example. Some of those products have actually worked really well during COVID, sort of counterintuitively, because that is the place that people sheltered in place and where they found their community and their ability to really work through the crisis. So I just wanted to add that, Chris, because it occurred to me as you were making that distinction between co-lodging and co-living, and that there's these kind of middle zones, along the spectrum. I think from a capital markets perspective, David, specifically to your question, my sense, and all of us, have spoken about this within the sector in the US anyway, a lot, I think that venture capital is very well suited to kind of prove out the thesis of co-living and to really kind of prove out the operational elements, and that is, those are truly scalable businesses that can benefit from kind of high octane, high growth kind of capital. I think when you think about the bigger, more institutional style investors, big sovereign wealth funds, large pension funds, foundations, endowments, those are the types of groups I think of on the other end of the spectrum in terms of institution. I think what they're looking for really is a very safe investment. And so I think where they're most likely to come into the ecosystem of co-living is on the asset side, is directly into the real estate itself. And I think that the frameworks and kind of the architecture from a management perspective that they expect to see, really reflects more the private equity industry than it does kind of a more of a tech startup kind of a thing. So I see that really as being, as the co-living sector evolves, the opportunity to build out infrastructure within these firms, hire people from more traditional sort of real estate investment backgrounds, put in place compliance frameworks, risk management frameworks, investment committee processes, the kinds of things that I think, Star City is in the process of doing, really creating institutional quality materials, and which Chris was a leader in. I mean that was sort of the most institutional of the products to date, is certainly the Long Island City Alta product. So a lot of it, I think, is around infrastructure building, and there will be this sort of spectrum, I think, of investors. It won't go straight to the biggest pensions and sovereigns, I don't think necessarily, but there will be a middle group of fund of funds, of forward-thinking family offices, of the allocators themselves, the guys like, Blackstone and Angelo Gordon and Fortress, who will, back the product. And so those are sort of the way I see the evolution. And then ultimately, we're going to have to see some sales. I think that will be kind of the thing, and hopefully that doesn't happen during, this, moment, because I think it is a very strange market. And when there are truly sales and we can see those exits, I think that capital will be sort of ever more enthusiastic about coming in to the sector in size, in the hundreds of millions of dollars, which is what I expect.
Do you see large institutions entering in the European market?
It's interesting. The European market, to be honest, I have a little less exposure to. What I would say is I have seen, because I think the European market is a little earlier in their trajectory in terms of adopting the co-living, concept strategy. I would say that it is more the venture capital style investors that have kind of dipped their toe in the water, and certain family offices, I guess, again, that are more forward thinking. In the US, I have definitely seen a lot of very large institutions learning about the space, spending a lot of time, a lot of energy, a lot of sort of diligence on the space. But we haven't, as of yet, seen that happen, with a large number of investors. There have been a few sort of anecdotal investments by larger groups, but that's kind of the way that I've seen it evolving.
Okay. Let me ask you something, Chris. What's your 3-year outlook on institutional capital flowing to the asset class, and what are some of the most important milestones for the asset class to achieve in order for this to happen?
Well, I think Stoney said it well. Probably the most important thing we need to see is a sale, of an institutional scale asset. The big question on everybody's mind that has been very difficult to answer is whether there is a, quote unquote, co-living penalty on the exit cap rates assigned to the NOI stream that these assets are throwing off. And I know, of my time at Ollie, we did everything we possibly could to ensure that there would not be a, co-living penalty. And we did that by making sure that the asset looked and felt in every way possible like a multifamily asset, right down to the fact that we set up floor plans that were indeed readily convertible back to conventional layouts. So I really think that getting a sale of an institutional scale asset, and hopefully at a cap rate that reflects no penalty for it being co-living, I think that's the single most important thing. The other thing we're living through right now, which is the one question that I could never answer for investors, and I can only hypothesize, was how would co-living perform through a downturn? And Stoney's right. I mean, it's the defensive properties of multifamily assets that draw in so much capital and make it very much a fixed income alternative, to investing in corporate bonds or government bonds. And so the investors that are looking for that profile of safe haven investment, and for them, change, innovation is not a good thing. Innovation means change, and change means risk from their perspective. And the reason why change means risk is because it's just been untested through, it's not been battle tested in the way that these other asset classes have been. So, the silver lining of this economic downturn, and it's hard to find them, I know, but the silver lining of this period is that it's not just an economic downturn. That all on its own would be helpful to be able to profile for the world and preview for the world the defensive properties of co-living. But more than that, this is actually an affront to social connectivity, and at least on a surface level, to density. Two of the key drivers of co-living, density and social connectivity. And so if you can have a pandemic scenario and co-living be able to demonstrate that it still has taken on these defensive properties. And again, so far, that's what we've seen. What I've seen across the industry, for at least where 12-month leases are in place, are a more defensive character, even to the extent where I know of assets that are collecting ahead of conventional multifamily collections in comparable locations. And so if co-living can do that, when there's a full-on global attack on social connectivity and density, then I think this period that we're living through right now will go down as one of the probably the single most important period in co-living's formative days to determining what the next 3-year capital inflows into the sector will look like over the next 3 to 10 years.
And David, I'll add one more comment, which is, in terms of seeing an exit, actually, I think the Alta project was refinanced, and that was a very, very positive, encouraging, I don't know, Chris, whether, I don't want to overshare on your behalf, but that was very, very positive in terms of demonstrating sort of a mark, not on a sale, but where, very, very large, very credible investors were going and putting a mark on a co-living asset. And you may be able to share more about that, Chris, but that was, I guess, an encouraging data point. And the second thing I think that will happen, that needed to happen for large amounts of capital to come in space, is a moderation in the market. It's very, very difficult for these large global institutional sophisticated investors to justify putting a lot of money to work at, what was broadly considered to be sort of the top of the market. So also counterintuitively, seeing a moderation, in pricing and in asset values, I think could be very positive for the sector, not for the world, of course, but for the sector as we think about capital flowing in.
Yeah, and I'll just fill in the blanks a little on Stoney's comments around the refinancing of Alta, Ollie's Long Island City asset. There was no distinction made in the cash flow, the NOI coming off of the co-living floors, and a third of that building is dedicated to micro suites, shared suites and co-living floors. 2/3 are conventional multifamily. There was no distinction made, no exercise that said, okay, let's look at the NOI coming off of the co-living floors versus the NOI coming off of the conventional multifamily units, and let's treat the two different. That did not happen. So the 30% plus NOI premium, particularly after adjusting for the difference in floor heights there, that 30% NOI premium being generated by the co-living floors was able to fully transfer into the valuation of the asset. And while it wasn't a sale of the asset, it was at least an institutional mark, a valuation exercise that had to occur to determine how much additional debt from the construction debt going to the permanent debt, how much additional debt could be layered onto that asset. So that was a very important exercise. And before that, the important exercise there was the fact that AIG had signed on to provide a construction loan. And this was really only made possible going back again to the fact that the floor plans had been set up in a way that were readily convertible back to conventional, so that we weren't asking the capital markets to underwrite co-living. We were asking them to underwrite a fallback scenario that looked no different than what they were already accustomed to.
Chris, I have a question for you, if you don't mind. As a younger company, we are actually obviously looking at multiple opportunities, in the market, and to build out some new buildings. And we always have this trade-off between, maximizing, density and like the kind of layout versus what you were saying about, retrofitting, the sort of the ability to retrofit at the moment of exit, which seems to be still pretty strong indicator for buyers. So how do you see that trade-off? And, are we going to see at some point investors fully embracing, the co-living, like pure co-living sort of shared layout? Or are we still, or is it like still like 10 years ahead until we actually can see that sort of full embracement by buyers?
Yeah, it's a really good question. And ultimately, I believe that this category, that the design in this category will not be constrained by conservatism in the capital markets and the conventional multifamily way of doing things. But we're not there yet. You kind of have, I feel like the industry has to kind of, master the craft before it can then, chop it up and kind of repiece it together in its likeness. At least if you're a co-living operator that has institutional scale ambitions, right? I do think that it's much easier to scale the category or to scale a brand in smaller locations, whether that's townhouses or kind of mid-rise locations that are less institutional in nature, and do so while being creative, and not just creative, but actually delivering what we all know the consumer wants. There were compromises we had to make, not because we were afraid the consumer wouldn't accept it, but because we were afraid the capital markets wouldn't accept some of these decisions. I think eventually we'll reach a day where those compromises don't need to be made, but I think that's at least 5, maybe even 10 years out before we can, break it and put it back together again in a better way.
Yeah, makes sense.
In this sense, let me introduce another question. If you want to talk about that, Steve, Luca, whoever, do you think it's time for local operators, or you as Luca as a global operator? Which model do you think it's gonna succeed in the long term? Because Chris was talking about it's still too early to chop the market and to differentiate it. But in talking about that, which model do you think it's gonna succeed, Steve?
Yeah, I think Stoney made a very good remark in which we can differentiate between the more vacation rental touristic operator, and we can differentiate into the more long-term residential operator. I truly think there's opportunities on both sides. I think also looping in some of the concepts Chris mentioned, we're going to see operators, they're going to be more institutional, less institutional. Answering your question, David, focusing and reframing it a bit, and answering your question within the loops of, let's say, I understand co-living as a long-term product. I totally agree that otherwise it's co-lodging. I understand co-living is, and I define long-term as anything between 9 to 3 years, 9 months to 3 years. For me, that's already mid long term, and I also we're putting on the framing as an institutional product, not something that you can scale to the thousands of units. If we answer that within this framework, I think operators are going to be local. I think maybe you're going to have a few flags, a few cities, but I don't foresee a co-living player the way we saw WeWork, in which, to put an example, on the co-working space, in which you have the flag in hundreds of cities. And I think this is for multiple reasons. I think the biggest one is scaling residential assets is a lot harder than scaling office. But I think it also has 2 very big impacts. One on the consumer side. Co-living, I believe in co-living as a middle income product. I believe in co-living at a price range that is maybe 20% above what it would cost me to go with 2 friends and get a flat of more or less the same level of qualities and get a cleaning lady twice a week and set up Wi-Fi. And the reality is that the consumers are not moving around that much. So the true benefits to the consumer are on a hyper local, on a hyper local network. And to put an example and to make an analogy, the benefit to the consumer is if I have 1,000 units in Barcelona or 1,000 beds in Barcelona, and not if I have 150 beds in Barcelona, 150 beds in London, 150 beds in Milano, etc., etc. And this happens for 2 reasons to the consumer. Number one, because they can access a series of shared spaces. That's what makes co-living different from traditional multi. And they're not traveling that much. It's people that live in the city and they're traveling between neighborhoods, but they're not traveling between cities every other week. And I think number 2 is the community. I'm a true believer on the importance of creating community. And in order to create community, you need mass. To make an analogy, if we have 100 beds and we have a reading book reading club, the 2% of our members participate, that's 2 people. If we have 1,000 beds and 2% of members participate, that's 20 people. So now it does make sense to have a reading club. You can really have a community. You can have sort of an interaction. And then we have the other side, which is the property management side. I think property management, as we all know here, it's a very thin margin business. There's very little milk to get out of the cow. And the reality is that it becomes very expensive to run these assets, and you have to be very efficient, and you need units, you need scale to be efficient. And the only way to do that, in my opinion, is by being a local operator, by staying hyperlocal.
Do you agree, Luca? Because I suppose that your approach is completely different.
Yes, so I think that, I mean, what Esteban says, it makes a lot of sense. I would argue that, I agree with him. It's great to have 1,000 beds in Barcelona. I agree, but it's even better to have 2,000 beds in Barcelona, 2,000 beds in London, 2,000 beds in Madrid and Milan, and so on and so forth. Right? That's I think the approach. Right? I think there needs to be a very, in my opinion, a distinction between what is the optimal way to get there. And I do agree that most of it will be a local operator to sort of the way there, but then there will be global consolidation, right? Because a lot of these brands, including ourselves, will want to sort of separate the two parts of the business. So there will be a quite commoditized part, which is the real estate at the bottom, and then there will be the sort of digital experience, community, brand, and technology platform on top. And I think that companies like us, where we want to continue to be asset light and so on, we will focus more and more on that sort of digital side, the platform on top, and we will try to consolidate at the bottom as much real estate as possible as a commodity, though. So the idea is that yes, there will be a lot of local players that will grow up in these areas in each city, but then eventually they will be consolidated under one global brand, or at least a few global brands. And because of the marginality of the business is not so high on the operator level, it really makes sense to have massive scale, in terms of operators. So I mean, it's not that I disagree. I really agree that you need to be local to scale within, successfully. But I think that eventually those players will be acquired, or at least fully managed by a few large co-living players, because there's just a lot of value into building that technology platform, that technology stack, and that digital experience throughout the different markets, right? And the idea of accessing a home like you access any other modern digital product, I think it's a very valuable idea that will need to be addressed by at least 2 or 3 brands globally. So that's basically where we stand.
Just to piggyback.
Oh, sorry. Go ahead.
Yeah, let me piggyback. We can close the loop on that, at least on my end. And I'd love to hear Chris and Tony's opinion and thoughts on that. But I truly believe on a fully fragmented market, the same way we see in multifamily, in which you go from mom and pop to the most institutional sovereign wealth fund on the asset class. I do think we're going to see some players starting in the US, big players. Some of them might even go and be publicly traded companies on the property management side. They might evolve and become like equity residential, or any of the other invitation homes, any of the other big vertically integrated multifamily. But long story short, I think it's going to be a very, very fragmented local market. And I'm talking about the long-term stays. I'm talking about the more institutional side. I'm not talking about the vacation rental, 3 months, global nomad. And I think that's a different story,
Yeah, and I'll jump in as well, Debbie, with sort of my thoughts. And it's funny because I'm an investor across, one platform that's literally these wonderful old mansions, in Oakland and Berkeley, where you have, 11 people living together and 16 people, and you planted your own vegetables in the backyard. And it's a very, very sort of a local vibe and a local feel that's really unique to that place. And equally involved with Chris's business, which I think, again, is really out, sort of one of the most evolved from an institutional perspective. And it's a totally different scale building. I think, almost over 400 bedrooms in the Long Island City project. And so that one really feels like a Class A institutional high rise. And my view on this being, sort of involved across the spectrum is that this is a thematic, sort of trend, which is why I'm kind of, very niche into co-living, but within the world of co-living, actually have quite a broad view on what will work. And so I think it's going to be both is the short, the clear answer. I think that there will be local players that can be very successful. I think that there will be global players that can be very successful. I mean, I think that there are certain elements of this business that truly benefit from scale. The leasing, the marketing, investing in technology to do, lease signings, virtual tours, a lot of that type of stuff, I think really does benefit from scale. I think on the other hand, cultivating a unique, authentic culture, is something that's better done, or potentially better done locally. And so because there's such a dramatic supply-demand mismatch in this, what I think of as kind of mid-market or upper mid-market affordable product that has a social element to it. There's just so much demand. And you look at a group like Common, right? They have 20,000 plus inquiries, I think, per week. And they or per month, and they have something like 40 to 60 vacancies in that same period. So it's like that the demand is so great that there is really a lot of room for a lot of different types of models to win. And I think it'll be not dissimilar to the hotel industry, where you kind of go, there's big brands, there's the Marriotts and the Hiltons and the Hyatts, and then there are little brands, that are the boutique bed and breakfasts or the boutique, local inns or the family-owned hotel, and that may have more uniqueness to that space, but for a specific demographic, they may be looking for a little more uniformity. So that's hopefully not a cop-out answer, but I think there's going to be room for everybody to win in this space, because I think it will be so big.
Yeah, one thing to add also is that I think we shouldn't get too hung up on the whole WeWork thing, right? I think that we don't need to confuse sort of issues with each other. Meaning that WeWork was has been a valuation issue and maybe overheads, as sort of too high pace growth or whatever, but it wasn't an issue on a sort of global brand and community. I think most people really loved being at WeWork. They really liked the idea that every company was opening a new office, and having right away that brand, that sort of, McDonald's-like feeling, where you go in a place, there's McDonald's, there's WeWork, that is the brand for office. So I think we shouldn't underestimate that just because there was mistakes made, in a different sort of area. And I think that, as valuations will correct and so on, then we will see also WeWork come back, strong within, showcasing what the real value is, which is like brand and community. And I think that can be applied on the sort of mid to long-term residential market like co-living as well.
And I think I agree with most of what's been said here. I think maybe one thing I would build on is, I'd say, in a lot of other categories, what determines whether a global sort of leader and how dominant that leader is to emerge, it's often looking at whether there are network externalities that the addition, it's a two-sided marketplace, like the addition of a new user into that network makes the rest of the network better. And with co-living, it really is a two-sided marketplace, where you've got on one end, you've got the end user, the renter, consumer, and on the other end, you've got the owner of the asset, the real estate. The network externality that I think is more significant than the fact that than the end user side of the marketplace, where joining a network exposes me to a larger community, or maybe to more buildings that give me access to more amenities. Well, I think that's great, and I think it is relevant. The stronger network externality, in my mind, has to do with the mindset of the institutional capital, which we've not yet seen flood into this space, but I think eventually a day will arrive where we do see a hockey stick-like trajectory of institutional capital flooding into this space. And when those portfolio managers are making the decision about who is the right operator for their asset and what is the right brand for their asset, they're going to be motivated in the same way that in the same thing that motivates all of their other decisions, which is risk aversion. How can I bring this asset to market and not lose my job in the process? And the safest thing to do for them will be to go with operators who are proven and operators who their friends in the portfolio management or asset management business are using as well. And so I do think that, but we haven't hit that point yet that creates that flywheel that will scale up one brand to be a dominant, or just a, maybe an oligopoly of brands to be the dominant players in the space. I do think that day will be upon us, and I do think it will be concurrent with the decision of institutional capital to flood into the category.
And the opportunity, I would add, in the meantime, is for those that are courageous and ambitious and innovation minded, right? The family offices and the high net worths and the fund of funds and those that already have discretionary capital, they're actually able to recognize the opportunity beforehand. I would say, when institutional capital comes into the market, it well and truly compresses cap rates, compresses yields, and it typically, historically, causes values to go up. And so there's going to be this middle zone where I think there'll be an opportunity for these this sort of courageous, ambitious capital to really sort of capitalize on the opportunity.
And the savvy capital, I think, will grab hold of the OpCo, investment participation as well, to the extent that their mandates allow them to, because by virtue of their decision to come into the space and back the real estate, they will be creating value for the brand and in the operating company itself.
Yeah.
David,
You're on mute.
You're on mute, I think, David.
Sorry. Do you want to add something, Luca? Because I've seen that you were unlocking the micro. Oh, that's okay.
No, that's good.
Let me ask you something from. Perfect. Let me ask you something from a point of view of someone that didn't know about the co-living industry since 2 weeks ago or something like that. Where do you see the market in 5 years? Do you think it's just a trend? Or do you really think that it's gonna be something that it's gonna stay in the market? I mean, as a Spanish guy, I would say that I think that Steva has a hard job, hard work to do. I don't see many Spanish guys getting into this market. Obviously, I'm not 20 years old or 25 years old, but do you think it's gonna stay, or it's just a trend?
Obviously, I think it's gonna stay. Otherwise,
obviously,
spending most of my time on this, right? But no, I think you bring up a fair question that is around sort of more traditional real estate markets, and how and how they would would they react, how long would it take to pick up the product, right? And I think that actually this is a question that again is more on the institutional side, because the demand is there and it's very, very strong. I mean, we always had pre-COVID we had 95-97% occupancy on all product everywhere in every city that we have reached, and I think this is going to stay. The macro trends about density and community and so on should stay, unless really there's this, unless the sort of remote work and this trend really picks up in a major way, which I don't think is going to happen within the next 10 years, at least in a way that affects the real cities and the shape of cities. So if that doesn't happen, then I think the demand is there. So it's more about how long will it take for institutional capital to really bet on this kind of model, rather than how long will it take for the customer, because the customer is already there. What is really lacking is still the supply side. This is really still the issue, and I think that as Stony was saying, like if we get the first few family offices and more aggressive thinking asset managers and so on to invest in the co-living industry, then the trend will sort of create the flywheel that is needed. But I think that this sort of your question is more about, I would say, on the supply side rather than on the demand side.
That's right. Let me ask you something. I have two questions. One of them is for whoever wants to reply. When do you think families will come to co-living scene?
This is one that I may be well positioned to answer because my kiddo just came on screen there a moment ago as I'm working from home, here during COVID. This is something that I have thought about for a long time. My journey initially into sort of collaborative living was through co-housing, which is this idea really of sort of for sale collaborative living product. It's typically like a condo project that's built, specifically for a preformed community. And that community is typically composed of families and has some element of sort of multi-generational piece to it. So something I've been thinking about a lot, since my inquiry into the space kind of started in 2001 when I graduated from college. And my view is that the demographic that's certainly the most, for whom this is the most relevant first is this millennial crew that I think many of us have been addressing, where people are getting married later. They have, student debt. They're not as excited about sort of home ownership. They want to be living in these sort of dense, energized urban environments. I think there's another crowd. This is, a long way to get to the answer, but it's, we sort of think of as like the Silver Sage group, which is, a group that where their kids have left, they're empty nesters. And I think that the product that's been developed today, is appropriate for them as well. I mean, the interesting sort of data point in this space is Common, who's one of the big, the very large co-living operators in the US, they have sort of over 2,000 residents and they're in, I want to say 48 assets, 7 cities. They have identified that opportunity, I think, from a demand perspective, and they have gone and partnered up with Tishman Speyer, which is a huge, sort of institutional owner of real estate, to create a company called Kin. And that is absolutely addressing the pain points, which I guess as parents, we feel very acutely. And it's like to have all of your own infrastructure around trying to think about childcare, trying to park a stroller in a small apartment in a city, whatever it might be. Those are areas that are very ripe, I think, for sharing and for collaboration. I mean, like I say, stroller parking, childcare, thinking about meals and nutrition and health and education, which I think people will be newly aware of how valuable it is to be close to other families and to have those sort of communities and networks in place going forward. And so I certainly applaud Common and what they're doing in Kin. And I think it will be a trend across the world. I think they are just the first to identify it. And so, it's happening in New York City. That's where they've been piloting this. Also in Long Island City, not far from Chris's first asset, and now also in Brooklyn. And so I'm just very hopeful for the sector, and it's happening already. And I hope it will happen.
I totally agree.
Oh, sorry.
I totally agree with Sonia, and I think that in our view as an operator, as an asset light operator, what we want to do is to build the sort of technology and digital platform on top, right? And once you have built that, and obviously the first adopters will be the millennials, right? But why? I mean, who says that you can't just change maybe the branding or like the facelift, for example, a mobile application, and you use the same data infrastructure, the same sort of application, and you just change the kind of services that you can provide to your clients. So if for millennials, you have parties and clubs and restaurants and so on, then for young family you can provide on-demand nursing or babysitting, assistance for children and so on. So you use the same technology infrastructure, the same also data that you can use as your customer evolves and grows up, and you can follow your customer until then. And ideally, you can even get to the elderly homes, which is already somewhat professionalized. But imagine in 20, 30 years, the elderly will be somewhat tech savvy and will be able to open a very simple app and order a nursing help or somewhat food or something like that to their apartment. So I think that the real opportunity, at least from the operator side, is to really build that stack so that then you can shift it and sort of grow with your customer to an ever extending basically total addressable market, which is actually quite infinite in that sense if you go beyond the millennials. And I think, as Sony said, we have seen it from Common. They have started doing that. I think they also entered into the multifamily homes recently with a new brand that I read about, that I can't remember how it's called, but I think that that's exactly what they're doing. They're building a centralized sort of digital product, digital infrastructure company, marketing, and so on, and then they will distribute it across different asset classes. I think that's exactly the way to go.
Now, I'll just add to that as well. I mean, when we talk about co-living, we always thought about it at Ollie as the 4 Co's of co-living: cost savings, convenience, comfort, and community. And irrespective of what age you are and what stage of life you're at, those 4 Co's are typically pretty universally desired: cost savings, convenience, comfort, and community. But I always thought that the most important Co driving the sort of entry-level professional positioning of co-living was cost savings. That young people had been priced out of the market, but it's not true just only of young people. The cost of housing across the board has, in these major cities, has really skyrocketed, and earnings power has not kept pace. So I think the real what it's important not to divorce from this conversation. Well, it's great to have the extra services and community, and I think that's really very critical for raising a family. I do think that the cost savings Co needs to be even more in focus than it has been to date. And the way that we tackled that in co-living was through density. The way that we did that at Ollie was through having rooms that had the same square footage, but with multiple purposes using transforming furniture. And so I think the design side of the equation shouldn't be lost here. The importance of the design side of the equation in driving co-living for families that is actually affordable and allows them the option then to stay in the city, because it's been able to shrink their footprint and therefore not demand that they pay for square footage that they don't use or that they don't value.
Sorry, do you think there is place for elder people? I mean, why not? Changing completely the view of how they have been approached since now. I mean, they were treated as if they were like, you are too old to live by your own. But maybe for people around 60, 65, it would be a good opportunity. Do you think there's a need there?
Yeah, without a doubt in my mind. And in fact, there are groups that are now pursuing this. And one that I'm familiar with and think highly of is a group called Proud Homes out of the Netherlands. I think it's a really important need. And if anything, you think about the every study, it seems like that I see on aging and sort of death at different causes of death. It seems like the antidote is very consistently community. And so I think fostering a sense of community and belonging among our aging population is probably one of the most important social impacts that co-living can and should have going forward.
Perfect. There's one more question from Connor Moore, who asked, even after the pandemic is behind us, what's the biggest worry for the co-living industry? And he also asked, how can the industry better position itself with this worry in mind? Can any of you reply that? Answer that? Sure.
I'll take that. I'll take a shot. I think here we have a connotation of associating co-living necessarily with sharing, and I think this is a mental association that comes with the word co-living. To touch on something that Chris just mentioned in the last minute that I think is tremendously important, I think it's about affordability. I think affordability is one of the key components. I think one of the realities is that a lot of the residents in co-living, their option is not co-living or living on their own. It's co-living or flat sharing, whether it's through Craigslist, whether it's through a Facebook group, whether it's through Bari in Europe. So consequently, no, I don't think that there is a major worry on the co-living industry, because it's people are already living with other people they don't know. It's just that the co-living space is sort of organizing that. And it's a funny thing, no? I think the connotation and the association that comes with the word co-living, at least a lot of the people who I'm in touch with are not necessarily in the industry. A lot of people have asked, hey, how come you're still doing this now when people don't want to be close to each other? And I don't know. I don't know how can the industry better position itself and can sort of get rid of this connotation, even if I don't think it's going to truly have an impact on people seeking out co-living brands and living in a co-living arrangement.
I agree with you, Esteban. And I would add sort of one layer on top of that, which is I think there's a question on people's minds, maybe a bigger question, which is like, are people going to want to live in city centers going forward? And I think that that's a totally rational, sort of question to ask. And I am, very, very firmly a believer that people will. A lot of that just comes from kind of my own journey, which is, having graduated from college in, 2001, we had the World Trade Center, September 11th issue. I now live literally 1 block from the World Trade Center. It was where my apartment in New York is. Immediately across the street from Goldman Sachs, right, which is the one between myself and the World Trade Center. And when that happened, we thought no one's ever going to go to downtown, Manhattan ever again, or when Hurricane Sandy hit, and you thought, oh, everything's flooded and the subways are a mess. And it's just, when are things going to recover? And living then in Hong Kong, afterwards, I mean, I started off in Saingpun, which was one of the areas that was the hardest hit by SARS, in 2003, which is precisely like the COVID, sort of epidemic or pandemic now on a smaller scale, to be fair. But like, and they put in place protocols and frameworks and architectures to make that work. And Hong Kong, recovered during the time that I was there in sort of 2010 to 2013 to continue to be one of the densest places anywhere in the world, and where people were, generating high incomes and living sort of very happily, and where rents and property prices were also among the very highest in the world. So I'm just a big believer that, while all of this is absolutely, tragic and has changed our lives, in various ways, that things, revert to a mean. And I think that young people particularly, and, the sort of target demographics for co-living, I think will absolutely want to live in cities going forward. And that just means the demand is there and the supply is not, and the opportunity remains very, very large. So.
Well, if I agree with Tony's comments entirely, and maybe in light of the sort of age that we're in right now, and I think the ability to have brought to light the sort of systemic prejudices that exist, within housing and within the broader society. One of my biggest concerns is forgetting about the health of co-living as an industry. It's just the social impact. I mean, I think what's driving a lot of us into co-living in the first place is the ability to have positive social impact. But from my point of view, from that lens, my biggest worry is that, that co-living doesn't go deep enough, that we're essentially saying, okay, in our Long Island City asset, it's basically like a $50,000 income earner and up. I think it was important that we halved from $100,000 qualifying income down to $50,000. There's still a lot of people who don't even make that $50,000 threshold, who still want the benefits of a more human housing experience. In my mind, this is, and this is something that my brother Andrew and I, going forward, as we take our knowledge from the co-living industry and apply it, we're really very focused on how do we drop that entry level, income threshold down to something that's even more suitable for an even wider audience.
I'm sorry, because they are saying me that we are out of time. Does anyone want to give their final thoughts about the industry, just to close the talk? Maybe Esteban or Luca or all of you, if you want to give your final thoughts.
I just wanted to thank you guys, Lucas, Tony, Chris, David. Thanks for participating. I think it was a great conversation. I look forward to seeing the video, but I think great thoughts were shared, and at least myself, I had a lot of fun. So thank you for being here today with us.
It has been
Likewise,
really a nice
same here.
talk with all
Yeah,
of us.
Thank you, David. Thank you, Seve, and applause to and praise to the guys in Europe that are really sort of carrying the torch and taking this movement into the future. Across Europe. That's just so exciting and so energizing. So glad to be here and glad to.
Maybe you can be the next investor.
That's I would love to. And I'd love to have a few good reasons to get over to Europe more often. So that sounds great.
Okay, that would be perfect.
Thanks, guys.
Okay, nice to meet you.
Thank you, everyone.
Bye.
Thank you. Bye-bye.
Bye.
Bye.